Hey everyone, welcome back to Steve's View. With Donald Trump now officially naming Kevin Warsh as his choice for the next chair of the Federal Reserve, the debate around the future of U.S. monetary policy has shifted from speculation to substance. The question is no longer who might lead the Fed, but what kind of Fed the United States is likely to have in the coming years. For many observers, the immediate reaction has been emotional. Supporters see Warsh as a long overdue corrective to what they view as years of policy misjudgment. Critics worry that this appointment signals political interference, a weakening of central bank independence, or even a Federal Reserve that simply does the president's bidding. Both reactions miss the point. To understand what this nomination really means, we need to step away from slogans and look carefully at three things: who Kevin Warsh actually is, how the Federal Reserve really functions, and what structural pressures are shaping us monetary policy, regardless of who sits in the chair. Kevin Warsh is not a political newcomer, nor is he an ideological outsider parachuted into the Fed. He is a product of the American financial and policy establishment in the most literal sense. Educated at Stanford, Harvard Law, and Harvard Business School, he built his early career at Morgan Stanley before entering government service. He worked in the George W. Bush administration and, crucially, served as a Federal Reserve governor during one of the most turbulent periods in modern financial history. That experience matters far more than partisan labels. During the 2008 financial crisis, Warsh was deeply involved in the Fed's emergency response. He worked closely with then-Chair Ben Bernanke at a moment when the global financial system was on the brink of collapse. Whatever one thinks of the long-term consequences of those decisions, it is hard to deny that Warsh understands crisis management, institutional coordination, and the trade-offs policymakers face when markets are breaking down in real time. But it is equally important to note that Warsh was never simply an extension of Bernanke. In the years following the crisis, when the Federal Reserve moved into large-scale quantitative easing and sustained ultra-loose monetary policy, Warsh became increasingly skeptical. He questioned whether prolonged asset purchases and near-zero rates were creating long-term distortions, mispricing risk, and encouraging excessive leverage. That disagreement ultimately led him to leave the Fed before the end of his term. This is a critical point, and it is often overlooked. Warsh has already demonstrated a willingness to break with institutional consensus when he believes policy is moving in the wrong direction. That history alone complicates the narrative that he will automatically subordinate the Fed's judgment to presidential pressure. At the same time, Warsh is not frozen in time. His views have evolved, and that evolution reflects changes in the economic environment, rather than personal loyalty to any one political figure. In recent years, Warsh has argued that the Federal Reserve has systematically misread inflation dynamics. He has criticized the Fed's forecasting models, suggesting they rely too heavily on backward-looking assumptions and fail to capture structural shifts in labor markets, supply chains, and fiscal behavior. From his perspective, the central bank has often been late to recognize both inflationary pressures and deflationary risks, resulting in policy that is reactive rather than strategic. This critique is not fringe. It is shared, in varying forms, by economists across the ideological spectrum. Where Warsh's current position has drawn particular attention is his openness to lowering borrowing costs and supporting rate cuts under certain conditions. For critics, this appears contradictory. How can someone once associated with inflation hawkishness now support easier financial conditions? The answer lies in context. Monetary policy is not a moral posture, it is a response to changing conditions. An official who insists on permanent hawkishness or permanent dovishness, regardless of circumstances, is not principled. They are rigid. Warsh's recent arguments suggest he believes the Fed has overcorrected for past inflation mistakes and is now at risk of constraining growth unnecessarily, particularly if inflation expectations are already stabilizing. That position happens to align, at least partially, with Donald Trump's long-standing criticism of high interest rates. But alignment does not equal obedience. The Federal Reserve Chair does not operate in a vacuum. The institution is governed by a committee structure, internal debate, and external accountability. Interest rate decisions require consensus, building among governors and regional bank presidents, each with their own perspectives and constituencies. No chair, regardless of personality or political backing, can simply dictate outcomes without navigating that process. This institutional reality is often ignored in public debate. There is a persistent tendency to treat the Fed chair as a monarch, rather than a coordinator. In practice, the chair's influence lies in agenda setting, persuasion, and framing. Not command. Warsh understands this system intimately. He has worked within it, pushed against it, and ultimately left it when he believed his dissent could no longer be effective. That background suggests a leader who is neither submissive nor reckless, but pragmatic. So what does Trump's nomination of Warsh really signal? It signals frustration with the status quo. Trump has been openly critical of the Federal Reserve for years, particularly over its reluctance to cut rates during periods he believes required stronger growth support. By choosing Warsh, Trump is not appointing an outsider intent on dismantling the institution, but an insider who shares the view that the Fed's policy framework needs serious reassessment. This is an important distinction. If the goal were pure political control, there would be far easier paths: individuals with no prior Fed experience, no institutional loyalty, and no public record of independent judgment. Warsh is not that figure. His record makes him harder to control, not easier. Of course, independence does not mean isolation. A Fed chair operates in a political environment, whether they like it or not. Fiscal policy, regulatory policy, global capital flows, and geopolitical risk all shape monetary outcomes. Coordination between the executive branch and the central bank happens implicitly even when it is not acknowledged explicitly. The real question, then, is not whether politics will influence the Fed, it always does, but whether influence crosses into domination. There is little evidence so far that Warsh would allow that line to be crossed. Another point worth addressing is the assumption that the next phase of U.S. monetary policy will simply be a reversal of the past. That is unlikely. Structural constraints remain powerful. Public debt levels are high. Financial markets are deeply sensitive to rate changes. The global economy is fragmented in ways that did not exist 20 years ago. Any Fed chair will be navigating narrow corridors, not open highways. What may change is tone and emphasis. Under Warsh, we are likely to see a Federal Reserve that speaks more openly about uncertainty, acknowledges past forecasting errors more directly, and places greater emphasis on policy flexibility rather than rigid frameworks. We may also see renewed debate inside the Fed about the costs of prolonged monetary accommodation versus the risks of tightening too quickly. That kind of debate is healthy. It is also worth remembering that central bank independence was never meant to imply infallibility. Independence exists to protect long-term stability, not to insulate policymakers from criticism. Over the past decade, the Fed's balance sheet expansion forward guidance practices and inflation-targeting strategies have reshaped financial behavior in profound ways. Re-examining those choices is not radical, it is responsible. From an international perspective, Warsh's appointment is unlikely to destabilize global markets in the way some fear. Markets care less about personalities than about predictability. Warsh is a known quantity. His views are public. His analytical framework is familiar. That reduces uncertainty, even among those who disagree with his conclusions. For allies and rivals alike, the signal is continuity with recalibration, not revolution. In the end, the debate over Kevin Warsh should not be reduced to loyalty tests or ideological labels. The more meaningful question is whether the Federal Reserve is capable of learning from its own history, from both its successes and its mistakes. Warsh's career suggests he believes institutions must adapt or risk losing credibility. Whether he succeeds in translating that belief into effective leadership will depend not only on him, but on the broader economic forces shaping the next decade. What is clear is this: the future of U.S. monetary policy will not be determined by slogans, nor by any single individual acting alone. It will be shaped by trade-offs, constraints, and judgment calls under uncertainty. Kevin Warsh will have influence. He will not have absolute power, and that distinction matters far more than most of today's headlines suggest. Thanks for watching.